Welcome to the New York Institute of Finance talk on the impact of COVID-19 on the financial markets. I'm here today with Doug Carroll, who's an instructor at the New York Institute of Finance and teaches a course in mortgage-backed securities and also a course in corporate finance and valuation. Doug is also the author of a book called The Insider's Guide to Fixed Income Securities and Markets. So today we're going to talk about the effect of COVID-19 on the real economy, also the impact on central bank liquidity provisions and quantitative easing, government stimulus, and also what are the prospects for the real economy and also equity markets. And last, we'll look at the impact of the Fed interventions on the economy and on fixed income markets. So to begin, we're going to talk about the effect on the real economy, look a bit at disruptions in the supply chain, layoffs, potential reductions in capital investment, and the infection rate. So in terms of the real economy, this is a graph of US exports and imports. And once again, this is not in dollar terms, it's in metric tons. So to some extent, it overstates the decrease in exports that you see going from around 14 million metric tons down to about 0. I didn't know if you had anything to say here, Doug.
No, Jack, just that this, as indicated by your comment, this is exports by weight and probably does overstate to some extent the decline in U.S. exports since there's a large amount of service exports by the U.S. and many of the goods are high value added goods. So not to minimize the decline in exports, but this graph may overplay the impact of COVID-19 on the export sector in the U.S.
Yep. And then looking at the effect on the Chinese economy, we see that over the same period, the Chinese economy has gone from about 40 to 50% of its normal output, all the way up to 85+% of output last week. And this comes with a caveat though, we've seen a dramatic increase in the level of output. But in order to sustain that level of output, the economy in China and also the export markets that China serves will need to recover also to maintain this level. Did you have anything?
Yeah, I would just add at that point, Jack, that that is an important qualification because as of this morning, the U.S. announced it was going to be on lockdown or stay-at-home protection through at least the month of April. And I suspect the same is true of much of the European economy. So as you indicated, for the Chinese economy to be able to maintain the high level of production, it is pursuant on a relatively rapid recovery in North America and Europe. Otherwise, they'll have a hard time sustaining that level of output if the markets aren't there for it.
Very good. And then in looking at the Chinese economy in terms of the strength of its consumer demand, we see that over the last 9 years, that the level of consumer debt has gone from about 10 trillion won all the way up to 55 trillion won. And at the same time, the level of growth in the Chinese economy has dropped from around 12% to around 6%. And that was last year. If we look at more recent results and estimates, it's predicted that the Chinese GDP will drop by 5% from the fourth quarter of 2019 to the first quarter of 2020. Doug?
No, nothing to add here other than this probably reinforces the economic weakness that is being seen globally. And I think the best estimates are that we're going to have a global contraction for at least the first several quarters of 2020.
Right. And I think you'll see not only a contraction of demand in the Chinese economy, but globally. And so that'll have a double impact on China. Okay. And then looking at unemployment, and these are predictions for unemployment rates in the US and the Euro area, we see that unemployment is expected to go from record low levels in the US all the way up to about 8% in Q2, and then gradually decrease to about 6%. Now, you have to keep in mind that this is an estimate given by JP Morgan. There are other estimates out there that show US unemployment getting well above 10% in Q2. And then compared to the Euro area, you see a very modest increase in unemployment that levels out and no real improvement after that.
Yeah, I would add here, Jack, that as you indicated, JP Morgan is probably on the conservative side in terms of forecasts for how high unemployment will rise. And some of the more bearish prognosticators are actually projecting unemployment rates in the very high teens or even in excess of 20%. And JP Morgan, by implication, is looking at the unemployment rate peaking in the second quarter. Normally, unemployment rates don't peak until after the recession is over, so that JP Morgan seems to be on the sunny side of things, both in terms of the height that unemployment rates will reach and the rate at which, by implication, unemployment rates are likely to fall again. Both of those would be, well, especially the recovery of the unemployment rate would be more rapid than has historically been the case in the aftermath of economic downturns.
Yeah, that's a very good point. So, and then looking at the impact on employment that the US and Europe suffered during the financial crisis, we see going back to 2009 that the level of employment or employment participation was roughly the same in Europe and the US in 2009, and that they diverged at that point where US employment dropped off much more dramatically down to about 75% participation rate, whereas the European participation rate declined more gradually, and then they eventually met and continued on at the same relative level.
Yeah, I would add here, Jack, that the reason underlying that divergence most likely is that while US unemployment compensation and other social support programs have historically been less rich and still are less rich than those in Europe, there was a dramatic increase in both the duration that one could collect unemployment benefits as well as other social support programs. And that probably explains to a large degree the greater decline in labor force participation rates in the US. And that might well be something we will see reprised in the aftermath of all of the actions taken by Congress, because again, they've put in place a lot of well-intentioned programs to support people while they're unemployed, both in terms of various grant and subsidy programs and increasing unemployment benefits, as well as increasing the duration for which they can be collected. And if the experience in the aftermath of the 2008 financial crisis is any foreshadowing, that would again indicate that there's likely to be a relative worsening of US labor force participation rates vis-a-vis Europe. Again, because while Europe is adding some benefits there, the increase in those sorts of benefits will not be as great. So consequently, the impact on US labor force participation rates is likely to be greater.
Okay, and now looking at the infection rate in the world, you see that, truly a global pandemic, but looking at this graph, the important things to note are the rate of infection increase. And what you see is that the US has the steepest rate of infection increase, much steeper than countries that seem to be harder hit in Europe, like Spain and Germany and Italy. And so it's hard to say where these infection rates will end up. So if the US continues on its trajectory, we could see cases in the hundreds of thousands just in the US. But right now, at least from what I've read, there's a lot of uncertainty about where things will start leveling off.
And it's probably important to note for our viewers that the right-hand scale is a logarithmic scale. So don't be misled by the relative linearity of most of those functions. If these were on an arithmetic rather than a logarithmic scale, they would show rapidly increasing slopes as moving to the right, so that it's not the rate of increase is constant. The rate of increase in infections, or at least reported cases of infections, the rate of growth is increasing in those reported rates.
Right, and just keeping that in perspective, after we have 10,000 cases, 100,000, the next bar after that, of course, would be 1 million cases. So, and we could be getting up there also. Okay, and then looking at the spread of the infection globally, you can see, although it is concentrated mainly in the US, Europe, China, and to some extent in Iran, that it is, truly hitting almost every country in the world. Next, we're going to look at the central bank's provision of liquidity and also quantitative easing programs. And these have had an impact on the treasury market, money markets, and also mortgage markets, primarily agency, but potentially also non-agency mortgage markets. But first off, we're going to look at the Fed's balance sheet. And we all saw that after the 2008 crisis, the Fed's balance sheet increased dramatically once quantitative easing was implemented and gradually reached a peak of about $4.5 trillion. In the last week, we've seen an increase in the Fed's balance sheet going from about 4.2 trillion all the way up to 5.2 trillion. So in 1 week, we've seen a $1 trillion increase in that balance sheet as the Fed intervenes in almost every market, providing liquidity and support. Doug?
Yeah, and the one thing to note for our viewers is, while the recent increase in the Fed's balance sheet on a percentage scale is ballpark 25%, whereas in the 2008 financial crisis, the Fed's balance sheet more than doubled in a very short period of time. One misleading bit created by the scale of the horizontal axis is the slope of that line is much steeper in 2020. So that, as Jack noted, that's an increase of about $1 trillion in a week, whereas a similar increase in 2008, similar absolute order of magnitude anyway, actually played out over several months. So we're obviously not at the end of this crisis yet, so that depending upon how well the Fed and Congress's actions impact the economy, how favorably they impact the economy, there could still be a significant increase, additional increase in the Fed's balance sheet on the way.
Absolutely. So one other area where we've seen a big impact on the markets has been the volatility in treasury rates. And so this is a graph of the 10-year treasury yield. And we see that rates were right around 2% or 200 basis points prior to the crisis, and then have declined dramatically, reaching a low a couple of weeks ago of about 30 basis points, and then rocketing higher to about 130 basis points in 1 week, and then back down the last week's range of about 10 or so basis points. So we've seen a decrease in volatility as the Fed has intervened in markets. There's less uncertainty. Doug?
Nothing to add just yet, Jack. We'll talk about some of the Fed's actions in just a few minutes, and maybe that'll be a nice counterpoint, or I should say, way of talking about how volatility is likely to proceed going forward.
Okay. And now we're going to talk a little bit about central bank liquidity and quantitative easing, which Doug will cover.
So here what we see is the Federal Reserve's policy rate, formerly known as the federal funds rate, the target rate set by the Fed. And what this exhibit shows is how long it took the Fed to get down to a zero rate. Obviously, it took a lot longer, although it was starting from a much higher level in 2008, as the overnight Fed funds target rate was 5.25, and took about 80 months to get down to zero, or 0 to 25 basis points, since they had a range target at that time. Now, clearly, the Fed in the recent crisis has gotten to zero a lot quicker, albeit from a much lower starting point. But even if we look at a similar level of rates in the context of the 2008 financial crisis in August or September of 2008, when the financial crisis was really coming to a head with Lehman Brothers failure and the conversion of Morgan Stanley and Goldman Sachs from investment banks to commercial banks. So the Fed funds rate target was at a not too dissimilar level from where it started at more recently, 2% versus a 175 top end of the Fed's target range now. You'll note the Fed got down to zero in less than 3 months, whereas it took closer to 4.5 months for the Fed to make a similar move. So this speaks very directly to how severe a crisis the Fed believes we are facing, that it brought rate down to about as low as they will set its policy rate, because the Fed's not likely to set a negative short-term interest rate. But the fact that they moved with such alacrity to get to zero indicates the Fed views this current crisis as potentially quite severe.
Yeah, and I remember when they did drop the rates so quickly, the initial market reaction was just, oh, they've overreacted, or, they've already, dropped them to zero, so they have nothing left that they can do, and the market kind of panicked a little bit there. But in hindsight, it seems like that was the right thing to do, and eventually led to a stabilizing of the market, although it took a little bit of time.
Yeah, well, I think that the Fed funds rate, or central bank policy rates more generally serve more as a tool for communicating what the central banks are trying to accomplish, rather than the primary tool they will use to try to resurrect the economy, because low interest rates are not necessarily stimulative. One can see that by the experience of the European Central Bank, the ECB, with rates at zero or negative for a decade, or the Central Bank of Japan, the BOJ, has had zero or near zero interest rates for 3 decades. So low interest rates are not necessarily effective at stimulating the real economy, but I think they are, because they're so visible, they're very clear at communicating what the central banks are trying to accomplish with their whole panoply of tools.
Absolutely. Then moving on to the fiscal stimulus.
And while we're discussing monetary issues, primarily in this segment of the discussion, I thought it would be helpful to get a sense of both the size of the fiscal responses. It shows on the horizontal axis from the beginning of the crisis how long before the policies in the case of 2008 were completely in place. And again, that was a period of well over 500 days, on the order of 80 months before all of the fiscal actions to be taken in response to the 2008 crisis were in place. And in the case of the US, Congress has passed an even larger in total stimulus bill in less than 100 days. And this is probably the first of a number of steps. They're already talking about follow-up actions of at least a similar order of magnitude. So despite $2 trillion in the recently passed legislation being authorized, $2.2 trillion, there's discussion of maybe ultimately 2 or 3 times that amount of fiscal stimulus. And one of the reasons we're mentioning it here is the fiscal actions, because in many cases they will be supported by central bank action, whether buying of securities or providing liquidity to various segments of the financial markets. These fiscal actions are likely to have a big impact on the money supply and ultimately on inflation expectations.
Very good.
Now, in terms of some of the specific actions taken by the Fed, which we've sort of divided into three broad categories, what you see here are the actions that are primarily related to, well, I hate to say traditional because these go beyond traditional, but relatively close to the traditional monetary policy actions taken by the central banks in general, or in the case of the US, the Fed in particular. So we've already talked about cutting the target rate, but other actions that are relatively similarly or closely aligned to traditional monetary policy tools. What used to be the primary way of stimulating the economy was by trying to induce banks to borrow from the Fed at the so-called discount window. Called the discount window because banks would have to bring collateral, primarily treasury or agency securities, and the Fed wouldn't lend them the full market value of the securities. They would lend a discount to the market value of the securities, ergo the name discount window. But traditionally, the discount rate has been at a premium to the Fed funds rate to discourage banks from borrowing from the Fed, to try to induce them to borrow from other commercial banks. Well, completely out of alignment with their historical action, the discount rate was set at the top end of the Fed's target range for the Fed funds rate. So not only encouraging banks to come to the Fed in general, but the Fed has also tried to, through jawboning, through their market commentary, dissuade banks from viewing borrowing from the Fed as carrying any stigma. Historically, when banks had to go to the Fed, that oftentimes carried the connotation that the commercial banks had to go to the Fed because other banks would not be willing to lend to them, creating the air of some concern about the creditworthiness of a bank that would have to borrow from the Fed. The Fed has actually encouraged banks that do not need to borrow at the discount window to go ahead and do so, to try to create sort of a herd immunity there. If everybody's doing it, then borrowing from the Fed cannot be in some way an indication that there's some concern about the creditworthiness of banks that are borrowing from the Fed. And the Fed also eased up on the range of securities that would be viewed as good for collateral. Historically, only treasuries and government agency and mortgage agency securities. They're allowing for a wider range of things, investment grade, corporate, municipal bonds, for instance. Also related to the Fed's more traditional activities of open market operations, buying and selling government securities, although in the more recent vintage that's been known as QE because of the very unhistorical size of such purchases, the Fed has expanded its balance sheet, as we saw in a previous exhibit, primarily through the purchase of government and mortgage-backed agency securities. Now, the Fed announced several weeks ago that they would buy up to $500 billion of treasuries and $200 billion of mortgage backs, agency mortgage backs, Fannie Mae, Freddie Mac, and Ginnie Mae. But then a little bit later, they refined that to say, well, they'd buy as much as $75 billion per week of treasuries and $50 billion per week of agency mortgage backs. Well, that would total 625. You'll note last week they purchased nearly $950 billion. And despite the fact they indicated the daily allotment of treasuries would be about $75 billion, one day last week they announced they were going to buy $107 billion. And then later that same day they announced an additional $15 billion purchase. That's the $122 billion in one day cited. That was just treasury securities. And additional things that I won't linger on in detail here, but the Fed for a while has been adding liquidity to the repo market for problems that started all the way back September of last year. But they've opened $3.5 trillion different repo market programs for a total of $1.5 trillion to support the repo market. And the Fed has engaged in swap lines with most other major central banks globally as a way of making sure there was adequate dollars to fund transactions in the financial markets and in the real economy globally by engaging in these swap lines with most of the major central banks globally.
Yeah, I think also that it's been, at least for the last few weeks or maybe even months, that we've had lots of things in the media about a dollar shortage or just, generally a shortage of dollars in the world. And then with the US exchange rate shooting up recently and then coming down a bit over last week and now going back up, this is certainly an important feature of the Fed's program.
Yeah, one point to add there on a tangentially related issue, the comment you made about the rising value of the dollar, even though treasury rates have gone down, as we'll see a little bit later, the spreads between the treasury and other borrowers has actually widened. So between higher interest rates for non-government borrowers and an increasing exchange value of the dollar, one of the potential stresses globally is a lot of dollar-denominated bonds and loans have been taken out by borrowers around the world, but especially corporations in emerging markets.
Right, and so that's making it much more difficult for them to repay those dollar borrowings. And the other aspect of it is, as the dollar gets stronger, it's going to have an impact on the competitiveness of the U.S. market or of U.S. Producers and service providers in the world. So.
Now, other Fed programs, and while we looked at the programs primarily geared towards the more traditional provinces of monetary policy, because of the stresses across the financial markets, the Fed has instituted a number of programs, each designed to support a specific segment of the financial markets that have been exhibiting a lot of stress. So in particular, commercial paper, which is primarily short-term corporate borrowings, maximum maturities of up to 9 months, although most are typically 3 months or less. Historically, those issues are not retired at maturity. They're rolled over. That is, the issuer sells new commercial paper to raise money to pay off the old commercial paper. And it's primarily a way of keeping open the access to the credit market, sort of a line of credit, if you will, that can be tapped as necessary. Well, given the uncertainty in the market, there's been a big pullback by investors in that market, and there was a lot of concern that the corporations would not be able to roll it over. So to prevent a credit contraction from originating in that market segment, the Fed has created the Commercial Paper Funding Facility, CPFF. You can see all the acronyms attached to all these programs, where the Fed will actually buy maturing commercial paper that corporate issuers are not able to sell to other investors. Now, it's not a blanket across the board guarantee, but as long as it's very top rated, the A1 or P1 rating, which are the top ratings you can get, then the difference has to do with whether you're looking at this from the Moody's or Standard & Poor's perspective on credit ratings, but those are the top ratings from the 2 biggest credit rating agencies. As long as you're a top rated issuer, the Fed guarantees that they will buy your issue if you buy your issue so you can roll over maturing commercial paper if you can't find other investors to do so. And that accounts for about 700 billion of an approximately 1 trillion market. Also, to make sure the secondary markets for debt securities stays reasonably well functioning, the Fed has put in place a program to lend money to primary dealers, the primary dealer credit facility. And the Fed was always willing to make loans against things like treasury securities and agency mortgage-backed securities. But given the big drying up of liquidity and the dramatic widening of spreads, the Fed was worried about liquidity almost completely evaporating in the credit markets outside of treasuries and agencies. So to facilitate the functioning of that market, the Fed has made a wider range of collateral eligible for dealers to use to borrow money from the Fed. And not only have they opened up to things like corporate municipal bonds, which heretofore had not been eligible as collateral, the Fed is even for the first time accepting equity securities within certain guidelines as collateral. And whereas these loans were typically very short term, they're making loans that extend out to 90 days, and they've promised to keep this program in place for at least the next 6 months. Also, the Fed's supporting the secondary market in investment grade corporates and munis. They actually contracted with Blackstone to set up a fund to buy investment grade corporate bonds and shares of exchange traded funds, ETFs, that hold corporate investment grade bonds. To support the real sector of the economy in a somewhat indirect fashion, and this is primarily to help consumers and companies that sell to consumers, the term asset-backed securities loan facility, TALF. This is a 2008 program that's been resurrected. And this will allow the financing of new issues of asset-backed securities where the collateral pool standing behind the newly issued ABS will be student loan, auto loan, or credit card receivable pools that provide the source of cash flow to the buyers of the ABS. Treasury, I should say, the Fed's not going to do this on their own balance sheet. They're going to set up a special purpose vehicle, SPV, as a way of investing in these things. But again, this is to guarantee the ability of originators of such loans to sell those loans into a securitization as a way of obtaining funds to be able to make loans to new buyers or new customers of the various sorts of assets that are being collateralized. And finally, there's the money market mutual fund liquidity facility. Because of concerns that money market funds might end up breaking the buck like they almost did in 2008. The Fed wanted to put in place a program that would buy assets from money market funds as a way of supporting them and avoiding distressed sales of assets by money market funds that would cause the net asset value of such funds to fall below $1 a share, which is sort of kept as the benchmark, as an indication of solvency and the ability of investors, large and small, to be willing to entrust their funds to a money market mutual fund.
Yeah, it certainly sounds like they're trying to cover all their bases here, and it seems like it's almost impossible to have any kind of illiquidity in the market with this kind of intervention. Yeah,
the only sectors that, at least the major financial market sectors that don't seem to have a specific program in place yet, are non-agency mortgage-backed securities and CLOs, collateralized loan obligations. In that last category, there has been a lot of securitization of leveraged loans. But right. While there is not yet in place a program for those asset categories, I suspect if there's significant deterioration in general or in those market sectors in particular, we're likely to see additional Fed programs designed to address those particular segments that haven't got their own program yet.
Yeah, no, they've actually been under a great deal of stress over the last few weeks. And I expect, the Fed is reluctant to go into that area, which is considered, much more higher risk loans, much more, like high yield bonds and things like that. But
yeah,
if it continues, but it's also an incredibly important source of funding for lots of middle market companies, smaller companies, and that debt is held very widely in the investment market.
I think you're absolutely right, Jack. I think that if the Fed, if they feel the need to set up a program, they'll again do it off balance sheet. They'll set up a special purpose vehicle, and they'll probably only take the AAA rated paper from those various sorts of securitizations, and they'd probably end up getting a contribution from the Treasury, so that if there were credit losses in these special purpose vehicles, the Fed itself wouldn't end up taking any of the losses. But I certainly suspect they would put in place a program to support those market segments if we saw significant deterioration in either of them.
All right, now we're going to talk a little bit about government stimulus, and these are mainly payments to individuals and either loans or payments to large and small businesses. So we talked about before, the stimulus is well over $2 trillion now, and what this diagram shows is kind of how that 2 trillion plus is divided up in terms of support to different sectors of the economy. And you can see about 1/4 of it is going to larger businesses and local governments in terms of loans and other financial assistance. And then large pieces going to direct payments to families, tax cuts. So these are where they're actually going directly to consumers and taxpayers. And then support for other institutions such as hospitals and healthcare, which is another area that's under a great deal of stress now. I mean, the healthcare business has always been, pretty much a cost plus business, unlike property and casualty. And this kind of incredible need for healthcare and healthcare facilities is unprecedented, as far as I know, in recent history. And then we also have loans for small businesses, which a lot of these things are designed to either be a loan, but if the small business or business maintains certain levels of employment, then the loan becomes more of a grant. So it's gradually forgiven as long as the business meets certain objectives, such as I said, maintaining employment. Last are expansion of unemployment insurance, which Doug talked about. So we're seeing an unprecedented nationwide unemployment insurance, which is normally tied to states, and states set the level of unemployment insurance compensation. The government has created a 4-month program where everybody's going to get at least $600 a week, which is quite a bit higher than most state benefits. Anything you had to say, Doug?
Yeah, and it's implicit in what you said, Jack, but in some cases, unemployment benefits might be higher than salaries. And they opened the legislation passed by Congress, opened the potential beneficiaries of the unemployment compensation to groups that were heretofore not able to participate, so that freelancers and even the self-employed, who historically have not been able to collect unemployment, are actually eligible for the programs created by the legislation passed and signed in the last week.
Well, I think they're recognizing that in the overall economy, the self-employed and freelancers have become a very significant part of that. And if you just have employment programs that are targeted at, traditional workers and more traditional businesses, then you're going to be missing a large segment of the population.
Oh no, I agree 100%. The so-called gig economy has resulted in some contribution to the increase in employment and the very low rates of unemployment. And if those groups were not included, there'd certainly be a large number of people that were missing the support for the lost income that historically had not been available to those groups.
Yep. Okay, and then the effect of the stimulus has been pretty dramatic. And what we're looking at here is going back to January, the weekly changes in each of the main US indexes, the S&P, the Dow Jones, and the NASDAQ indexes. Once again, these are just weekly changes, not cumulative changes over the period. And so what we see is that not too much going on in January and February, and then at the end of February, the market is sort of waking up to the potential losses from COVID shown on February 28th, where all of the indexes were down more than 10% that week. And then a slight rebound, a little bit of hope. And then once again, after that, all the indexes down a little less than 10%, and then down more than 15% in that week. But then last week we had a rebound. of anywhere from about 9 to 13%. And the thing to keep in mind here is that if you look at these on a cumulative basis, the drop in the market through March, the week of March 20th, was about 30% or so in each of the indexes. And now that we've gotten an increase of around 10% last week, we're still down around 20%, which is the traditional dividing line between a bear market and just a sell-off, a regular sell-off. Doug?
Yeah, nothing really to add other than, again, what's probably implicit for any people that are parsing your words. We're probably in a high volatility period for a protracted period of time. Not to get too wonky, but the VIX, the volatility index, for a good chunk of years, until a few years ago, was probably between 10 and 15%. And the volatility index has been up in the range of 60 to 80% more recently. I'm not going to try to define all that in detail, but the fact that the volatility index is up by 6 or 8 times or 5 to 8 times what it had been indicates that the market is anticipating relatively high volatility for the foreseeable future. Volatility is not going to be something in the rearview mirror because it's going to be a long while before we really know what the outcome of the full incidence of COVID-19 and how effective and how long it will take for them to be effective is going to be the case for all of the economic policies governments around the world are putting in place.
Yeah, there's definitely a lot of fear and uncertainty in the market, and the VIX, as you said, had gotten up into the high 80%, and then I think its lowest it's been recently is down in the 50s, but historically unusually very high, unusual levels of volatility. Okay. All right, now looking at the real economy.
Yeah, so more Fed actions, because while the Fed historically has tried not to involve itself directly in the real economy, they try to influence the real economy through their more traditional monetary policy actions. But following up on some of the programs put in place in the aftermath of the 2008 financial crisis, and even going beyond that, the Fed is getting directly involved in acting in a way to support players in the real economy. Now, one of the Fed's, or more generally central banks' responsibility has always been a lender of last resort. So in the normal run of things, they're responsible for trying to influence the course of the economy through the traditional monetary policy tools. But in a financial crisis, and that was literally why the Fed was created, to fight financial panics, they become the lender of last resort. Traditionally, primarily to financial institutions, but when necessary, to real economy players. So that top point is actually playing off one of the earlier slides that were showing the division of the $2.2 trillion of fiscal stimulus. Part of that is, well, it says here $300 billion loan/subsidy program. So that's that loan that might turn into a grant program to be available to small businesses. So the Treasury has actually transferred $30 billion to the Fed, which the Fed will use to lever up to as much as $300 billion of loans to try to support employers, consumers, and businesses. And these are loans that the Fed will not make directly, but they will oversee a program through the Small Business Administration, the SBA. And the SBA itself doesn't directly make loans, but they oversee historically commercial banks that had qualified for an SBA lending program. But to encourage a wider casting of the net, they have opened up the application to participate in this lending program to any FDIC, Federal Depository of Insurance Corporation, that is, FDIC insured bank, credit unions, or even financial technology, fintech lenders. So they're trying to make loans as readily available as possible. And while this $300 billion is what was announced by the Fed, this morning I saw an article where an interview of Steve Mnuchin, the Treasury Secretary, was touting that this could be as much as $350 billion. So they're hoping to get a lot of money into the hands of businesses and consumers that way. But then in addition to the support to the secondary market for corporate bonds, the Fed, through a special purpose vehicle, is also going to buy new issues of corporate and municipal bonds, again, investment grade, but also through the special purpose vehicle, make loans to investment grade corporate and municipal borrowers. And one of the things the Fed is doing outside of the direct expenditure is they're using their so-called jawboning. That is, they're talking to the commercial bank lenders to ease up on the way they're policing their loan portfolios. The Fed has a significant role as a bank regulator, and this is a sort of the parallel to the encouraging banks to borrow at the discount window to get more reserves into their hands. The Fed is telling banks to forbear a little bit more. Don't try to foreclose or force a borrower into default simply because they've missed a loan payment or an interest payment. And as a way of trying to emphasize that, that forbearance they're trying to encourage, the Fed has done a couple of things. They're suspending the bank regulatory capital requirements for some period of time. I believe it's at least for the next 6 months, so banks don't have to meet a reserve requirement. And in addition to that, whereas normally as soon as a bank recognizes that a loan is not performing, they have to write down the value of that loan from whatever the principal amount was to what they think they'll ultimately be able to recover. Those write-downs used to have to occur as soon as the loan was recognized as being non-performing. That is, a borrower had missed some specified number of payments. The Fed is now telling banks they don't have to write down non-performing loans for up to 2 years as a way of emphasizing that forbearance for delinquent borrowers that the Fed is trying to encourage, because historically at least, financial panics in part impacted the real economy by a contraction of credit as borrowers defaulted and their loans were foreclosed on or pushed into default. And the Fed is trying to defer that or prevent that sort of credit contraction from happening, both by making money available to the borrowers and then encouraging the lenders not to place the payments with the normal rectitude that the Fed usually encourages.
Very good point. Yeah, relaxing the reporting of non-performing loans and taking those credit losses, for originally immediately, and now they're not going to have to recognize them for 2 years, will have a big impact on, what kind of profits and performance the banks will show.
Well, I think, Jack, this is actually a recognition of that very issue contributing to the contraction in 2008, because those rules of immediate write-down were in place, and as assets were written down, the banks were short of capital, so they have to sell assets to get capital, but the asset sales were forcing even further down the market prices of those assets, forcing them to have to take additional write-downs, et cetera, et cetera, et cetera. So I think the Fed's actions are wise in the way they're trying to short circuit that sort of self-reinforcing contraction of credit in the economy and the contraction that forces on the real economy.
Yeah, absolutely. All right. So now let's look at the prospects for the U.S. economy and also equity markets, and look at some of the changes that have occurred in those markets. So the first is a shift in investors' risk tolerance. So as Doug was saying, and I was saying also, you've seen really large increases in credit spreads, much higher volatility in the equity markets, a big drop in prices of riskier debt, big drop in equity prices that we saw, more than 30% a little over a week ago. It's just showing that investors are, kind of pulling back quite a lot, a complete flip in terms of investor sentiment from the end of last year. We saw, stock markets reaching records, just a real willingness to take risk. And now that we're seeing kind of a shift in that, this is going to have a big impact on the value of riskier assets like equities and non-investment grade debt. One other aspect that has been talked about is that the companies that are taking loans and possibly grants under some of these programs by the Treasury and the Fed, that they're talking about limiting those companies' ability to buy their shares back. And this is something that has a lot of popular political appeal, but we have to keep in mind that share buybacks have been the main support for the market for the last 8 or 9 years. So share buybacks, or companies buying their own stock back, has been the major demand in the equity markets, and net really the only demand net in the equity markets for quite some time. So if you start limiting buybacks, you'll do two things. You're going to eliminate a natural support for the market, a natural source of demand. You're also going to divide the market into two types of companies. Companies that are accepting government assistance, generally companies that are experiencing a lot more adverse conditions in their market and their businesses, and then companies that have actually done very well or have remained stable during the COVID crisis. Companies like Apple, although they've taken some hits, Amazon, Zoom, companies like that. And so you're going to create two tiers of companies in the market. Those that may have already had problems, had to borrow money or take money from the government and now cannot buy their shares back. And then those that have not really had very many problems, who are actually quite cash rich and will continue to buy their shares back. I don't know if you had a view on that, Doug.
No, I would maybe just to reinforce some of the things you said about the cash-rich firms, even some that have had difficulties. You'd mentioned Apple, for instance, had shuttered all their stores in China for over a month, and they just reopened them in the last week. And then in the last week, Apple shut all of their Apple stores outside of China. So clearly Apple's business has been adversely affected, to say nothing of the disruption to its supply chain, given that so much of their assembly and production of the components of Apple hardware is done in China. But Apple's sitting on about $100 billion of net cash. That's cash and short-term investments in excess of the debt on their balance sheet. So even those companies adversely affected in terms of their operating performance, as long as they're cash rich, whether it's an Apple or an Amazon or a Facebook or a Google or whoever, per your comment, I think there'll be a pretty significant tiering in performance of the companies that can't buy back their stock versus those who can, who are in many cases likely to view this as a buying opportunity, retiring equity at relatively low cost, and thereby reducing their weighted average cost of capital to enhance the value of the equity going forward.
Yep, and the last thing I wanted to mention just briefly was looking at private equity and also private debt, which are pretty much intertwined. So private equity are companies that are held by either private equity firms or have been taken private, and generally they were acquired using lots of debt. It has gotten to be a lower percentage recently, more like 60%. It used to be 70 or 80% debt. And there is some concern that as lenders decide to pull back from lending to companies like this, the leveraged loan market and the private lending market may cause some failure of some of these companies and potentially a liquidation of these private equity holdings. So I didn't know if you had anything.
Just to support what you said, Jack, Several of the market segments you identified that were under pressure, both the high yield debt market, because sometimes the buyouts are funded in part by issuance of high yield bonds, and the leveraged loan market. Those are where a lot of that debt ended up in the hands of investors. And to the extent that either of those market segments come under pressure, that could result in some much more rapid than anticipated liquidation of some of these private equity investments. So I don't think we've seen too much pressure there yet, but if those market segments worsen and there are not Fed or other programs that support them, it ultimately might force some fire sale of private equity interests in companies that had been acquired by private equity investors.
Yep. Okay. Anyway, so the last thing that Doug and I are going to talk about are just, looking at the impact of Fed interventions, which we've already discussed to some extent, and then Doug will talk about, what is the potential for 10-year Treasury note yields to go negative. So in terms of, what the Fed has done and has it had a real impact on the market, the first market we're going to look at is the high grade or investment grade debt market. And what you see there, it goes back to about the beginning or close to the beginning of 2019, is generally the spreads on investment grade debt are anywhere from 50 basis points up to possibly 200 basis points, although that would be a very high spread on investment grade. And we saw that spreads were right around 100 basis points or a little more than that for quite some time, and then shot up to 370 basis points during the crisis. Now, the Fed has had an impact on those spreads and brought them down to more like 300 basis points. But keeping in mind that the baseline was right around 100 basis points, we're still about 200 basis points of credit spread more than we had before the crisis. Did you have anything you'd like to add, Doug?
Yeah, just a couple things. One of the things that's implicit in the diagram or the graphic we're looking at that you can't see because this exhibit doesn't reach back to the financial crisis of 2008, the spreads for investment grade debt had gotten even wider back then. Depending upon which study you looked at, investment grade debt widened to 400 to 500 or more basis points above treasuries. So the speed with which the Fed acted this time is indicated by the fact that the spreads only got to 370 basis points rather than the 400 or 500 plus. And clearly the market over the last week or so has been positively impressed by the Fed's action so far, but spreads are still 100 basis points wider than they typically get at the bottom of a recession. It's only when you have a crisis like in 08 or today, you've seen spreads at anything like the width they are at in the investment grade sector. So what we're seeing is a positive vote by the investment grade credit market, but still sort of wait and see because I don't think that the investment grade credit markets think we're completely out of the woods just yet. Positive first votes, but still waiting to see how much more happens and how the financial markets and the real economy evolve going forward.
Yeah, you're absolutely right about the financial crisis. Investment grade spreads did get close to 600 basis points, especially on the triple B. And what we see in the market now is that the investment grade market is really dominated by triple B rated securities. So this is the bottom level of investment grade, and it is the grade at which predominates in that category. And so you may see spreads go higher if the Fed is not successful in controlling the fear that lenders have, lending to these companies. or if you see downgrades, where a lot of companies were sort of skimming on the edge of triple B to double B, and so sort of skimming on the edge of going into high yield or non-investment grade status. So you might see that also, which I think the percent of triple B companies going into this crisis is much higher than it was going into the financial crisis in '08.
Yeah, that's absolutely the case, Jack.
Yeah. And then looking at commercial paper, kind of the same story there. We had a market where spreads on commercial paper were almost non-existent. I mean, commercial paper is a market for generally very good credit borrowers to borrow short term. And so you can see that after the financial crisis, where spreads widened out to about 150 basis points, things really settled down to them being zero, even negative back in 17. And now we've shot up even higher than the financial crisis in this category, going to over 200 basis points of spread. But the good news is that the interventions and programs that the Fed has implemented have been able to bring that level down to about 130 basis points, still very, very high by the standards of the last 10 years.
Yeah, and just a couple things to note here, Jack. The one difference between this and the previous exhibit was when we were looking at corporate bonds, those were spreads to treasury rates. Here on commercial paper, they're looking at spreads to US interest rate swap rates. That OIS that you see up there, that's the overnight index swap rate. So just so people are clear, the spreads were zero or negative, not to treasuries, but to US dollar interest rate swaps. And there has been a dramatic improvement, although as Jack noted, the improvement only brought spreads down to where they were at their worst in 2008. So that's still an indication that the market has nowhere near fully recovered. And there's some thought that the Fed might have to tinker a little bit with their commercial paper program. Because there's different segments of it, but one segment of it requires that firms borrow at the overnight index swap rate plus 300 basis points, so that as of yet, most of commercial paper issuers have not been going to the Fed because even though they're paying a big premium over what they traditionally do in terms of spreads to other investors, the Fed in this case is charging a penalty rate so that it's a backstop that's there in case no other investors surface. But at least as of yet, most commercial paper is still being rolled over to other non-treasury or non-federal investors, but at significantly higher borrowing costs than had been the case.
Absolutely. Okay. And then last, we're going to look, or Doug's going to talk about the potential for the yield to go negative on the 10-year T-note. So Doug?
Yeah, and this is a topic that gets brought up occasionally because there have been a number of significant government benchmark bonds, in particular the 10-year German government bond, the 10-year Bund, or the 10-year Japanese government bond, the JGBs, that have been trading at negative yields off and on or almost continuously for many months, or actually in some cases, some number of years at this point. And given that the sort of global benchmark status of the 10-year T-note, US 10-year T-note, and the fact that most at least would think that given the size of its economy and its tax base, the US Treasury is probably less of a credit risk than a 10-year JGB or 10-year Bund. Well, if those securities have been trading at negative yields, shouldn't we expect to see the same on the 10-year US Treasury? Well, there's a variety of things that probably militate against that outcome. I mean, of course, no one knows what the future holds and anything's possible. But one thing that makes I'd read as a strong indication that the 10-year T-note will not trade at negative yields is clearly one of the factors that influences risk-free interest rates, i.e. interest rates on government bonds, are inflation expectations. And while the Fed's actions so far in this financial crisis have been on an order of magnitude similar to those in the 2008 timeframe, there is likely a significant difference. Most of the Fed's expansionary monetary policies in 2008 resulted in expansion of bank reserves, not so much an expansion of the money supply. And inflation expectations are probably much more tightly aligned with changes in the money supply growth rates rather than directly with bank reserves. And one significant difference this time around versus 2008 is that many of the actions the Fed is likely to take, for instance, the small business loan program that they're going to oversee through the SBA, and their secondary market purchases of corporate and municipal bonds and asset-backed securities, those actions are likely to result in an increase in the money supply. So the fact that we're likely looking at an expansion or an increase in the rate of growth of the money supply, that would likely indicate that investors would not buy treasuries at negative yields if they thought inflation rates were going to be 1 or 2 or 3%, because that would imply a very negative real rate of return. So while, again, anything's possible, I would say, given the likely course of Fed action and its impact on the money supply, that we're not likely to see negative interest rates on intermediate to long-term treasuries anytime soon. Well, yes, bills are negative, but short-term securities are another matter.
Absolutely, and I agree with you there. You know, inflation expectations today measured against the TIPS versus the Treasury spread for 10 years was about 1%. And I think the market recognizes that this unprecedented stimulus in terms of the money supply, provision of credit, and also direct payments to businesses and individuals and everything will, you know, as you said, lead to an incredible increase in the money supply and also demand that would probably keep inflation alive, even if we have, you know, a fairly rough period here. So, okay. Well, that's what we have today. And I'd like to thank Doug for joining me here. And if you have any questions about our presentation, there'll be an email that will be available so you can reach out and ask us about it. But thank you, Doug. Enjoyed talking to you. And
it was my pleasure, Jack.